Hey everybody, how you doing tonight? It's me, Gherkinit from Pickle Financial, and I just wanted to real quick go over a couple of the things about the information that I was talking about earlier on stream and the post on Reddit that kind of has blown up and maybe flown a little away from where I intended it to, but I did want to go over the points because I think they're still relevant and I think there's important information here. During the HFSC meeting today, we watched it live on stream, pretty much for the whole stream from when it started at noon. The head of the DTCC made a statement, and it's right here, and I'll cover that real quick.
Clients would have to worry about trades being consummated. I think that's the story that I think that is getting lost somewhat in this somehow, is that the system worked. I mean, there was incredible volumes. The system processed that volume. There was big changes in margin. Firms met that margin. Nobody was defaulted. Nobody was pushed into that situation from a firm basis. And the impact on the retail client obviously is something that both the SEC and this committee hopefully will come back with recommendations of.
So basically, what he implied there is that, in fact, nobody was short called during the run up in January. I believe this means that, in addition to nobody being short called, nobody covered their positions or their short positions as well. As we were led to believe, Melvin Capital lost 4.5 billion plus an additional 2.75 billion provided by Citadel and um, 0.72 was infused in them in order to keep them afloat based on their losses from the quote unquote short squeeze that occurred. There's been a lot of evidence that a short squeeze didn't really occur there, that it was a gamma squeeze. Um, and there was an assumption that Melvin was about to be margin called or going to be margin called, and there were margin issues with Robinhood as well. So the head of the DTCC has confirmed that none of that was the case. Buying did not need to be restricted as Robinhood's liquidity issues were solved immediately, and there were no further problems there. And so the restricted buying, I believe, plus the infusion of cash into Melvin Capital, were designed in order to prevent margin calls on higher interest positions in shorting GameStop, such as Citadel, possibly 0.72. I don't really know that much about them. Maybe somebody else wants to look into it. But if we look at Archegos as like a basis for like what's been going on in the market recently, we know that Archegos, based on the meeting today, in fact, they reported it. Archegos was 7 times margined. And with Melvin's $12.5 billion in holdings means they could have been margined up to 87.5 billion. And so that last little bump of 3 billion, maybe it may have been enough. If you multiply that by 7, that's $21 billion more margin. That may have been enough to prevent them from being margin called. I believe if they were margin called during the squeeze in January, the price of the stock would have gotten much higher, regardless of the restricted buying from Robinhood, as they would have had to have bought back their position on the open market. And I don't think that would have been possible. I don't think they also I don't think they covered from the time after the squeeze on 22 to 224, as the average price is 57.76. There would have been 80 million shares for the shorts to have covered in a 17-day trading period at that new low price. And that's been the lowest price since that time. Was our low at 38.50, and that started at a high of 158. And at the average price across that time period, that would have been $4.62 billion to cover the 80 million reported shares sold short. And that's not even counting any possible synthetic shares. That's just what the actual like SEC short volume was counted at, was like 143% of the float. 3 of those days had less than 10 million volume, so I don't think any shorts were covered on those days. And there's some indication that like they say that the run up from like $38 up to like 120 or wherever it ended on like February 26th or whatever it was caused by shorts covering their position. But I think at a higher price point, the reported losses for Melvin and Citadel of 4.5 billion and Citadel 3% of their gross holdings would not have accounted for a higher priced covering of those positions. So if the price was above 57.76, and especially all the way up to like 120, the cost to cover would have been significantly more than 4.62 billion, 8 billion and up, depending on how big of a position needed to be covered. Remember, this was predatory shorting that was occurring. They were attempting to short the company into obsolescence. And so there's good reason to believe, and good reason still to believe, that the number of shares sold short on GameStop far exceed the actual reported data of 143% back in January, and also far exceed the current data of 30% reported. And we know that, they've been able to cover failure to delivers vis-a-vis deep in the money options contracts. But that's basically $8 billion that were spent, plus blatant market manipulation and fraud on Robinhood's part, used in tandem to prevent this from exploding in January. And that's my position on it. I'm not trying to spread misinformation, but this seems to be lining up in a way where I think there's a valid reason, at least to look more into this. Don't take everything I'm saying as absolute truth, but I do think that there's something to this. And on that note, there's something I want to point out here, where if we look at the volume sold short on 122, 125, 126, 127, 128, you can see that the short volume, it didn't exceed, but 54 million short volume on 122 to 76 million long volume. So of that volume that day, almost 40% was sold short. So they were shorting all the way up through the gamma or whatever situation happened there, and they were shorting all the way down, and then they were shorting down here also all through that $30 range where they supposedly covered, and then the short interest actually increased as the stock price went up in late February. On 225, there was 32 million long volume, and there was 50 million short volume. So on that rise in January, where people are saying that they possibly covered, that was the point at which they would have covered from a low cost point. The short volume actually exceeded the long volume on those days. The short volume has continued to exceed the long volume basically all the way up until now. And where if we look at the short volume traded in the last week, we can see that almost every day from today all the way back to 423, almost 60% of the volume sold on the market was sold short. Now, does that mean those positions are being held? No, but it does mean that like an exceeding amount of short volume is being used against the long volume to suppress the price. I think the name of the game that they're trying to play is to wait us out. Hopefully, after a long enough period of time of them paying interest, they will be able to start closing out of these short positions, some which obviously run up into the hundreds of dollars, like during the squeeze and in the early rise in late February. We can see that some of these short positions are quite a high value. And so if after all this is said and done and they're able to wait us out of our positions, there is a chance that they can bring the price back down either to a level where it's more economical to cover, or they could bring it back down and bankrupt the company. or force illiquidity and cause them to go into debt, and then hopefully force bankruptcy off the back of that. I don't think it's possible for them to do that based on the fundamentals of GameStop, but I think that's their plan. I think they ultimately believe they can win. Some of the new upcoming rules changes and stuff could affect that and possibly force them out of their positions. But yeah, as you can see, just from the data here and the statements from the head of the DTCC today, we're really looking at a situation where they're essentially trapped in this position, as to get out of it would cause such a meteoric rise in the stock price that the cost to cover would bankrupt them, right? So they're not going to willingly bankrupt themselves in order to cover this position, because they don't care what happens to the market, right? As long as they're able to win in the long run. They may have plans to go long on the stock and try to make the money back as the squeeze happens to cover their positions. But essentially, he kind of just came out today and confirmed that anything that we thought about them covering those positions or being like margin called on those days was not true. So there was some DD going around that they in fact did get margin called, and that's what caused the run up in price, and that's what caused the run up in price from $35 was a margin call. It was like another margin call, but nobody's been margin called. The only people that have been margin called this year that I can find information on is Archegos Capital, or Archegos, and then that's it. Robinhood went onto the brink of it, and they were loaned money. Their liquidity issues are solved, and they were allowed to continue to keep trading. That, however, does not mean they allowed us to continue to buy GameStop, hence halting the FOMO, which I believe was rising and about to trigger a massive margin call on all these short positions. And so that's my working theory. I'm willing to hear other opinions on it. I'm not 100% sold on it myself, but that's where I stand. I just kind of want to let everyone know that my intention is not to misinform the community or anything. It's just that I see evidence in the data that they haven't covered. I also see, evidence in his statement that they probably should have been margin called, and a lot of liquid capital was thrown into the mix in order to prevent that from happening. And, these companies don't just throw money at each other for fun or because they're buddies. Like, there's a reason behind, saving Melvin Capital when they were in that position, which I think, goes behind a lot of the theories that, started this whole thing and have kept it going this long. So, at least there's a lot of confirmation bias out there. It's going to take me a long time to dig through it and find all the information I want to, but that's kind of where I stand. And so I just want to let you guys know and give you like a quick little breakdown of kind of what was going through my head today as I was thinking about that. And I will see you all tomorrow, bright and early, 9 a.m. And if you like the video, like it. If you don't, dislike it. Let me know down in the comments why. Maybe you have an argument I haven't heard yet, and I'd be glad to hear that. If you want to see more of my videos, you could drop a subscribe, and you could support the channel over on our Ko-Fi, which the link is down below. Thank you guys so much, and have a wonderful night.